All right, good morning. We're live again for another episode of Money Morning. How you doing, Andrew?
Good, Richard. How are you doing today?
Yeah. So we took some requests from last week's video. Guys, if you have a topic you want us to cover, make sure you comment below because we won't know otherwise. So this one comes from a gentleman that said, Rich, could you go and do a video on bankruptcy repercussions here in Canada? I think overall, bankruptcy gets a bit of a bad rap, and it's not as bad as what some people think, although there's some underlying truths about it that most people don't know about it, which we're going to cover in this. But I think from my perspective, and I want to hear you chime in after this, Andrew, if you've got way more debt than what you have assets, let's say you've got 100 grand worth of credit card debt, lines of credits, and you own next to nothing. You own, in fact, nothing. Let's say you're a renter. You don't have any property. Bankruptcy is probably not a bad idea. What are your views on it?
I agree. It's case-by-case basis. It all depends on your circumstances. Income is a major component of bankruptcy costs. Assets are a major component of bankruptcy costs. Family situation is a major component of bankruptcy costs. So all those factors taken into account, it is case by case, but the consensus, generally speaking, if you have that kind of debt, 100 grand without any assets, bankruptcy probably might be the cheapest and quickest way out of debt for you.
So the first thing that comes to mind for most people with bankruptcy is their credit rating. And surprisingly, bankruptcy is not as damaging to credit as what a consumer proposal is, which is what most trustees will try to sell people. And it's only because the proposal takes longer. They usually run about 60 months, 5 years or so. Sometimes you have a middleman involved and they take the first couple months, so it may run a little bit less on the proposal side. But either way, it's about a 5-year program. But damage to credit, can you talk about that with bankruptcy versus a consumer? Actually, first, just for people that might be newer to it, can you distinguish what a consumer proposal is versus a bankruptcy? Because both of these are offered by a trustee, although I've seen a lot of trustees, it's kind of underhanded the way that they sell it, but some of them will, say something like, this is the best way to avoid bankruptcy, and they'll sell you a consumer proposal, which is in fact worse for your credit. So can you talk about what those two are and what you think about damage to credit with those two?
Sure. First, I should distinguish and advise our viewers that neither of us are licensed trustees under the Bankruptcy and Insolvency Act, which is federally regulated. With that said, consumer proposal and bankruptcy differ in essentially the term of your proposal, or the duration of your repayment schedule. So if you're a first-time bankruptcy filer and your income is below what is known as the surplus income rule, then you're in a 9-month discharge with bankruptcy. So it's a pretty quick elimination process if you qualify for that program. If your income is above that threshold, the income surplus threshold, your bankruptcy discharge is 21 months. So it's basically almost 2 years. So the consumer proposal being a maximum 60-month program, in which most of them are a 60-month program, the difference is basically two times as long in a consumer proposal. Your monthly payments in the proposal will vary based on various circumstances, but overall, the amount you repay in a consumer proposal will exceed the amount you repay in a bankruptcy. And the reason for that is twofold. One, I believe it's part of the legislation under the Bankruptcy Insolvency Act that the creditors recover a greater percentage or a greater sum of money in the proposal than the bankruptcy. That's the first part. And the second part is trustees are court-appointed agents for the creditors, although most people believe the trustees work for them. So the trustees' interest really is getting as much money back as possible so that they can recover as much money for the creditors, as well as charge more in fees, because the trustee is able to take a percentage off the top for fees in administering that proposal. So
it's still 20% of the payment, right, with a consumer proposal?
It's 20% off the top of what is recovered, plus there's additional administration charges that they will charge to the cardholder or to the consumer. So I would think the average is about 23 to 25% is the overall recovery that the trustees are able to take.
Then it's more than a 20. So when I was doing the lobbying with Queen's Park on Bill 55, about, I don't know what it was, 7 or 8 years ago, at that time they were charging 20% fee on payments sent to the creditors. So let me just put that in perspective. If you have, let's just use $1,000 worth of debt, or let's just use $1, we'll keep it simple. If you have $1 of debt and the trustee has arranged for you to make a repayment schedule back to the creditor, they're going to earn 20 cents. Okay. Now, with the proposal, it's sold as sometimes as a settlement. I've heard them use that term, not always, depending on the outfit and the sort of language that they want to use with their marketing. But it's not really a settlement in the sense with what we do at Total Debt Freedom. It's still kind of a settlement, but the problem with it, though, is that they get paid more when they get more money back to the creditor, because they don't get paid a percentage of what they save the customer. They get paid a percentage of what goes to the credit card company. So if they can send them $10,000 instead of $8,000, they're making 20% of the $2,000 difference, which is pretty significant. It's an extra $400. So you just have to understand that their motivation really isn't to save you money. Their motivation is, even though you're paying them for the service, is to get as much money back to the credit card company. So that's a good point that you brought up, that they're essentially court-appointed agents to the creditors. We talked about middleman scams last week, so we'll skip that. I just put that in the notes, but you can watch last week's video. You'll see it there. They'll also often push consumer proposals over bankruptcies. It's almost like, I don't want to say bait and switch, but sometimes the way that some of the conversations I've heard and some of the marketing strategies look like, it's like, if you sell something that is the best way to avoid bankruptcy, but it's viewed as far as damage to your credit as worse than a bankruptcy because it takes longer, to clear up the debt and get it off your credit report. It's a difficult argument to say it's the best way to avoid bankruptcy, because in actuality, in my view, a bankruptcy is a better approach for most consumers to get out of debt. It's just the trustee doesn't make as much money at it. I don't know, what do you think?
Good points, yes. But as I said earlier, it is case by case, so it's hard to kind of blanket everybody into which category would be best for their personal circumstances and finances. But if you look at it from afar and say those that have no assets, bankruptcy would be the quickest and likely the cheapest way out of debt, with the fastest recovery to your credit in exchange to a consumer proposal. But if you do have assets you're trying to protect, if you have RRSPs, RESPs, if you have property, stuff like that, then a consumer proposal might be the better option, because you can retain those assets and not have to surrender them to the trustee. So it all depends on your circumstances. Mm-hmm. So I'll put that back to you.
So my next talking point I wanted to cover in this broadcast was the total loss of control when you deal with a trustee for a bankruptcy or a consumer proposal, which some people might actually see as beneficial, because they don't want that control. They don't want any flexibility. They just want to take it all, shove it across the table to the trustee and say, here, take it, you deal with it. And all they do is they follow the rules after that. But you basically take all of your assets, meaning what you own, your home, your car, tools of trade, stuff like that, household items that have any value. There's certain exemptions for the value of your vehicle. There's certain exemptions for the value of the property. There's exemptions for tools of trade. So if you're a mechanic, for example, and you have a tool chest, you're obviously not going to give that to the trustee to liquidate to pay your creditors, because you need it to earn money. So they have certain exemptions in place for that. But as a general rule, the trustee handles the entire process, and they take control of your assets and your liability. So not just the debt that you owe, who you owe money to, but they also take control of your monthly cash flow, your income, and your assets as part of the liquidation process to pay off the debt. Did you want to add to that?
No, that's all accurate. In terms of bankruptcy, one of the differences between bankruptcy and consumer proposal is that in a bankruptcy process, if you're filing bankruptcy, the trustee does examine your financial situation regularly, and based on your finances, may adjust your payment schedule into the bankruptcy. So if you have a windfall, inheritance, if you have a bonus, a commission from your employer, anything along those lines, if you've got some kind of additional windfall for that month, the trustee will assume that income in a bankruptcy. In a consumer proposal, they don't do it that way. So income tax returns, if you're getting one and you're typically receiving $1,000 per month in April, May of the year from Canada Revenue Agency, you would stand to lose that in bankruptcy, whereas in the consumer proposal, you will not. Once you've locked into the proposal term, let's just assume it's a $500 monthly payment for the 60 months over the consumer proposal. That's what you pay. It's $500 per month. It's locked in. You can actually pay it off quicker, but you must make that minimum $500 payment per month to the trustee. So there's a difference there too.
Yeah. I mean, overall, if you've got a ton of debt, again, if you got a ton of debt and it's not working, you got to take a different approach to getting out of debt. Most people will go looking for things like a debt consolidation loan, and you usually can't borrow your way out of debt unless you've got a load of equity in your home and you can take out a first or second mortgage at a lower interest rate than what you're paying on your credit cards. So borrowing your way out of debt here in Canada anyway isn't that feasible. There are companies that offer loans for people with credit card debt, but the interest rates can approach 60%. I mean, they usually start around 35% and they go up from there. So we don't encourage people to try to borrow their way out of debt by paying more interest on a debt that they couldn't already pay off. It doesn't make any sense. There's a few other schemes out there to help you get out of debt, but most of them are under the guise of nonprofit credit counseling or for-profit credit counseling. And either way, it's not that they don't make a profit. It's just that they have this nonprofit status and they have to spend a certain money on advertising. But again, kind of like what a bankruptcy trustee does, they generally speaking work for the creditors, and they're not encouraged to save you money. So let's put it that way. But back to the original question of this week's topic, the guy said, could you do a video on bankruptcy repercussions? We've covered the mainstay of them. If you're considering bankruptcy, speak to a licensed trustee in bankruptcy. They make it pretty clear that they're licensed trustees in bankruptcy. Just Google in your town, bankruptcy trustee plus, Oakville, if you live in Oakville, for example, and you can ask them how it all works there. If you want to get an alternative approach to dealing with the debt, Total Debt Freedom was created for that very reason, almost 17 odd years ago now. We've eliminated, I don't know, I've lost count. It was under 100 million, well over 100 million now, worth of credit card debt. We've had thousands of very satisfied customers, A+ rating with the Better Business Bureau. Link in the chat. I'll post it over here and I'll put it in the top comment. It's a Canadian company, so we can't help you if you live outside of Canada. If you're an expat, for example, though, and you've left Canada and you have Canadian debt, and you live in Singapore, Hong Kong, or somewhere else in North America, we can still help you if it's Canadian debt, but there's no cost for the consult. You'll at least get some information as far as what your options are and some alternatives to bankruptcy. And if our program isn't a good fit, we will refer you to a bankruptcy trustee. We're not going to hold back and say, don't do it. It's just, I know that most people try to avoid it as, they know what the stigma is all about, and that's fine. I totally get it. Before we wrap up, did you have anything else that you wanted to add, Andrew?
One thing I wanted to add is I want people to understand that when they're speaking to a bankruptcy trustee about their situation, they really should get the trustee to give them an estimate for both bankruptcy and a consumer proposal. Don't just go to the trustee's office and let them know what you're going through, and then let the trustee advise you what they want you to go through, which usually is the consumer proposal. Viewers must be educated in that they have to ask the trustee for what a bankruptcy would cost them and what a consumer proposal would cost them. And then that individual client or that individual person can make an informed decision on what they want to do based on those numbers. There's no reason going into a trustee's office, getting told you need to pay $500 per month in a consumer proposal for 60 months, when potentially you might be given a quote of $350 per month over bankruptcy. So you do need to have your information at your disposal, and you need to ask the trustee for both numbers, bankruptcy and consumer proposal.
Yeah, don't let anybody shame you into, oh, you should do this because it's not bankruptcy. Just because it's not bankruptcy doesn't mean that it's better. To be honest with you, there's times where our program is better than bankruptcy, and there's times where ours is not better than bankruptcy. And if that's the case, we'll send you to a bankruptcy trustee straight up. But the problem that I've noticed about these offices is that they make more money with a consumer proposal, and they like to use advertising lingo that basically says, not a bankruptcy, it's the best alternative, sign up for this, but it's administered by the same office. It's viewed upon by the creditors in a worse way because it takes longer and it sits on your credit longer for 5 years. So just consider those things. If you have any questions, we've already pinned the link for TDF. You can book a free consult with somebody in our office and get some more information about your debt. Basically, the litmus test is, If what you're doing is throwing money at interest payments and the balances aren't going down, and you've been doing that for 6-12 months, you can do that for another 6-12 months, but at the end of the day, you're just burning through more money. So your best bet is, okay, I recognize I have a problem. Let me go talk to somebody and see if we can find a solution to this that at least eliminates the debt in a actionable, a productive way. So subscribe, like, comment below. If you guys have a topic suggestion, we'll be on again next Saturday morning, 9 a.m. Eastern Standard Time. So again, if you guys have a topic suggestion, just drop it in there. All right. Thanks, Andrew.
You're welcome. Thanks, guys.